Stefan, you ready? Okay, well,
yes, we can start
now. Okay. Yeah, this is the announcements. Good morning, everyone, and welcome to today's webinar. My name is Guy Menon, and I'm the Research and Knowledge Manager with Making Finance Work for Africa. Today, we have a webinar on the sub-Saharan African Pan-African banks and their impact on financial sector development. We will unpack some of the knowledge, lessons, and policy recommendations from a study led by a team of researchers from ODI. But before we jump into the subject, allow me to go quickly over the housekeeping items. So far, we've had 282 participants registered to this webinar, which will last 1 hour. All microphones are muted, and you can ask questions during the session. For today's session, you have a minute to ask your question live, of course, or 2 minutes if you would like to comment on the study or provide any views on the subject. You can also, of course, use the Q&A box at the bottom of your screen. And as always, slides and a recording of this webinar will be available after we conclude on Making Finance Work for Africa portal. In case you are experiencing any technical issue, please send a quick request for support, and our technical team will be more than happy to help. Finally, please remember to fill out our survey that will appear automatically after the session. We are interested, of course, in your feedback, and we look forward to your comments. This ends our housekeeping. Briefly about Making Finance Work for Africa, it's a G8 initiative hosted at the African Development Bank. We focus on financial inclusion, long-term finance, and financial stability and regulation. Our members includes, on top of the African Development Bank, GIZ, AFD, the French Development Agency, Afrexim Bank, the European Investment Bank, the European Commission. You can access thousands of news articles and publications on Making Finance Work for Africa online library, mfw4a.org. This concludes our brief presentation. 2 weeks ago, we held a session on sub-Saharan African interbank markets, where we looked at factors that are impeding the development of efficient interbank markets. We also discussed some of the recommendations from the authors and the policy implications. Today, we have a different topic at hand, this time on the role and impact of Pan-African banks on financial sector development. This session is chaired by my colleague, Mwazu Ibrahim, and I will conclude, of course, this session in about an hour. But for now, and without any further ado, I'll give the mic to Mwazu for his intro and for leading this session.
Okay, thank you everyone, and welcome to this second webinar series. Like my senior colleague mentioned, this is the second webinar, which is exclusively going to be on the impact of Pan-African banks on financial sector development in Africa. Of course, the importance of financial sector development for countries' economic growth, reducing poverty and inequality, and of course, supporting and achieving the sustainable development goals cannot be overemphasized. So given the key role of financial sector development in promoting economic growth, there have been several efforts aimed at actually identifying the critical drivers aimed at improving the country's level of financial sector development. Of course, earlier research efforts have been done. For instance, further studies have actually been done to unearth some of the key macroeconomic determinants, key legal issues surrounding cross-country differences in financial sector development, how countries' level of institutions also support financial sector development. What has been critically missing in the existing evidence has been the role of Pan-African banks in explaining cross-country differences in countries' financial sector development. And given the proliferation of Pan-African banks in sub-Saharan Africa, this particular study is actually much more needed now than ever. So in terms of this particular research actually hinges on the gaps in the existing literature, following the scanty literature on the impact of Pan-African banks on financial sector development, to pull the available scanty evidence together in terms of producing a synthesized report. So this particular presentation is going to be done by Sherilyn Raga, who is a senior research officer based at Overseas Development Institute. And Shelley will also be supported by Judith Tyson, who is a research fellow and a senior in the development special finance specialist, also based at ODI. And we are also fortunate to have Sheikh Mian, who is the director of investor and partner relationship at Ora Bank in Togo, to give a brief, remarks after the presentation is done, of not more than 2 minutes. Thank you very much, and over to you, Sharon and Judith.
Thank you, Moaza, for that introduction. So good afternoon, everyone. It is great to be part of the Making Finance Work for Africa webinar series, and it is our pleasure to present to you today the findings of our paper on the impact of Pan-African banks on financial development in sub-Saharan Africa. So for a brief background, our DEGRP paper examines existing evidence on the impact of regional banking on financial inclusion, deepening, and stability in the context of the rapidly rising subsidiaries of banks headquartered in African countries, which are also known as Pan-African banks or PABs. So the analysis of this paper benefited from the research funded by the UK ESRC and FCDO, as well as from peer review of academic researchers in this field. So for today, we will cover three main areas. First, I will discuss the drivers of regional banking in sub-Saharan Africa. Second, I will present the emerging impact of Pan-African banks on financial development in the region. And finally, my colleague Judith Tyson will present some policy implications. Next slide, please. So first, let me present to you that the expansion of regional banking in sub-Saharan Africa has been facilitated first and foremost by the financial liberalization reforms in the late 1980s, which eased entry of international banks in general, both from within and outside the region. So throughout the 1990s, the banking systems in sub-Saharan Africa have steadily shifted from predominantly state-owned to becoming privately owned, and then to having higher levels of foreign ownership, such as by 2013, foreign banks hold almost 60% of both the region's total banking population, but also banking sector assets. So in most countries like Burkina Faso, Eswatini, Madagascar, Mozambique, and Zambia, foreign banks virtually hold the entire total banking sector assets. However, following the global financial crisis in 2008, advanced economies implemented tighter regulations and higher capital requirements, which resulted in the retrenchment of traditional European foreign banks from the region, and this has opened opportunities for PAB players to fill the gap left by these traditional banks in the market. But aside from these regional and global factors, particular country milestones have also driven PABs to expand in the region. So for instance, the end of apartheid paved the way for expansion of South African banks abroad. In Nigeria in 2005, when the central bank increased banks' minimum capital requirement, this has led to bank mergers and acquisitions and raised excess capital at home, which enabled these domestic banks to expand beyond Nigeria. So on the empirical literature, they generally categorize home and host country factors that drive PAB expansion. So as you can see in the upper right-hand side of the slide, home country factors are those that pushes PABs to search for better yields and increase diversification of their assets outside the location of their parent banks. So this is because, for instance, PABs in home countries with relatively stable economies and deeper financial markets, for instance in Kenya, maybe experience already lower returns on their investments at home, pushing these PABs to search for better yields elsewhere. So this is confirmed with what we've seen in the empirical evidence showing that the lower the return on equity at headquarter location, the more PABs expand throughout the region. PABs in home countries with also increasing trade openness also tend to expand, showing that PABs tend to follow their clients who might be expanding or venturing out within sub-Saharan Africa. Meanwhile, there are also host country factors or elements that attract PABs to invest in particular host countries. So for example, PABs headquartered in East Africa tend to be prevalent in countries with lower minimum capital requirements and lower levels of income, potentially so that these East African PABs can utilize their extra capital in low-income countries in dire need of financial services. We also find evidence that Kenyan PABs tend to be in countries with lower bank efficiency, which potentially enable them to compete through relatively better cost management than banks in those host economies. More generally, in the empirical literature that we've looked at, it appears that major PABs expand in host countries that tend to have lower GDP growth. And to some extent, they can also tolerate lower institutional quality as long as inflation and exchange rates are relatively stable. So there are also country fare factors that attract PABs to invest in a certain country. So they tend to expand in countries with closer geographical proximity, for example, if they share a border with them, or with cultural similarity, for instance, having a common language. So having discussed all these drivers of PAB expansion in the region, currently what we have is that we've seen PABs steadily rising from 94 banks in 2003 to over 173 banks, and that's more than a third of the total banking population in sub-Saharan Africa as of 2012. So by 2015, 10 major PABs alone have a more significant footprint in sub-Saharan Africa than banks from outside the region. At present, for instance, EcoBank alone, which is headquartered in Togo, reaches 23 clients across 33 African countries. We also see that PABs have been offering a wide range of products ranging from personal to investment banking to commercial and SME banking, and now also to infrastructure financing. PABs expansion also led to more jobs. For instance, Standard Bank Group alone employs 50,000 staff across 20 sub-Saharan African countries. PABs are also estimated to bring about 376 million worth of investment in bank subsidiaries annually, and they hold over 10% of deposits in 31 sub-Saharan African countries. So to give you a picture of the size of PABs relative to their home countries, consolidated assets of Bank Africa is equivalent to 28% of Morocco's GDP. That of Standard Banks is equivalent to 45% of South Africa's GDP. And that of EcoBank is equivalent to 430% of Togo's entire national output. So all this make PABs economically and systemically important to both their home and host countries. Next slide, please. So moving on to the impact of PABs, what we find is that the PABs' relatively higher exposure to lower market segment that have higher default risk actually shape the PAB's impact in the region's financial access, deepening, and stability. So let me go into details. So first, the evidence suggests we saw that PABs increased African firms' access to finance, especially to those small, large, and young enterprises. But however, the impact on households is less clear-cut, since we find that some evidence are showing that PABs appear to favor educated middle class. However, case studies show some positive impacts, especially, for instance, Nigerian PABs are cited to be responsible for increasing up to 35% growth of bank branches in the Gambia. Kenyan PABs are observed to leverage their expertise in agent and mobile banking to reach wider population in East Africa. Meanwhile, Moroccan PABs in West Africa target lending to SMEs and bank households and infrastructure projects. In Uganda, there are also reports that PABs tend to be more willing to cater to non-prime borrowers than major international banks. So these trends are promising, since global banks in the region typically concentrate their services in corporates and extractive sectors. So second, PABs also tend to increase banking competition and efficiency. They were found to be cost efficient in producing loans and other earning assets, and even more efficient when they are medium-sized banks. However, most PAB's profitability is lower than foreign banks, reflecting on one side PAB's greater exposure to lower quality portfolio, and on the other hand, foreign banks' cheaper sources of funding that lower their operational costs. In addition, PABs, on the brighter side, have been actively participating in other financial market segments such as interbank, government securities, and foreign exchange markets. Thus, they contribute to market deepening and price discovery. For example, in Nigeria, the participation of PABs in open market operation was said to be helping moderate the level of interest rate structure in the country. In Malawi, they observed that PABs withdraw or inject foreign exchange into the system depending on market conditions. So this opened up PAB's role in currency substitution, for example. In recent years, PABs have also been leading arrangement of syndicated loan and bilateral loans for infrastructure in sub-Saharan Africa, a role that has been traditionally dominated by European banks. So third, we can also look at the PAB's effects on microprudential stability, and the evidence is mixed. So on one side, as we've discussed, PABs tend to have higher exposure to assets with higher default risk, such as SMEs, which in turn weaken these banks' own balance sheets. But another important red flag that we're seeing in the literature is that the competition induced by PABs pushes also other banks to take on more risky activities in order to maintain profitability. So this increases the non-performing loan ratios of these banks and thus increasing the vulnerability of the banking sector as a whole. So in this aspect, we can see the link between microprudential to macroprudential risk. On the brighter side, though, there is evidence that PABs tend to be least cyclical in terms of their lending behavior compared to foreign and domestic banks. So this indicates that if the PAB's market share becomes more dominant, they may reduce the procyclicality of lending over time, which may help stabilize African countries, especially when in their crisis period. So I think I wanted also to flag another important macroprudential issue is that PABs are becoming systemically important in the region. For example, we find a study citing that 7 major PABs alone hold more than 70% of total banking sector deposits in Benin, Chad, Central African Republic, and Mali. So hypothetically, if one systemically important PAB gets in distress, it will be widely affected. It will be widely felt by other financial market segments and commercial ventures this PAB directly engages with. So in addition, there's also evidence that PAB's lending behavior are affected by shocks from their home country, making them conduits of cross-border risk, not only between their home and host countries, but also to and from African and non-African financial systems, since these PABs have also connections with financial centers. So given all this risk and development in the PAB, among PABs in the region, may I now turn over the presentation to my colleague Judith so she can discuss some policy implications.
Thank you very much, Sherilyn and Moza. Could we have the next slide, please? Thank you. So as Sherilyn mentioned, the scale and complexity of Pan-African banks is quite notable, and this really makes them systemically important institutions in their host countries. And the complexity of their banks, as well as their scale, so complexity, we're thinking about operations and risk management, make them more challenging to supervise. So the first thing I would highlight really is that there's a need for national authorities to ensure that they are closely supervised and that the regulators have the capacity to deal with increasing complexity, so that they build their capacity to match the rising difficulty of supervising some of these institutions. I mentioned to you, of course, that much of this is already in hand and has been highlighted by national regulators. Obviously, though, the other challenge that they bring is inter-regional risks. Again, Sherilyn highlighted the fact that they can increase cross-border cross-border risks. And I would say they do that in two ways. One is through cross-border transactions, and in particular, a regular feature of these kind of banking groups would be movements of liquidity and capital between subsidiaries and branches. Some of these institutions also have regional approaches to risk management, such as consolidated risk and trading books, which means that not only are they more complex inherently, but also their operations are significantly more complex. Given this, there's a case to be made for greater inter-regional cooperation across regulation. Obviously, across jurisdictions that are supervising different parts of these banking groups. Basic cooperation really involves exchange of information and views and keeping other regulators informed about what is happening in the host jurisdictions. But there can also be more substantive changes, and in particular we highlight two aspects of that. One is around regional harmonization of regulation. Again, there are already initiatives in the region that are directed towards that goal. Quite a lot of them are sub-regional, so in East Africa, South Africa, Southern Africa, or in West Africa, but it would be good to see more progress on that in order to ease regulation of these large institutions. And secondly, there's a development, there's potential for development of formalized regional supervisory colleges. Again, we have already seen progress towards this amongst regulators across the region, but further deepening of that would also be great. Lastly, we mentioned the issue around financial stability. Again, Sherilyn highlighted some of the findings in relation to issues such as the basic creditworthiness of the client portfolio of institutions being pushed down market without potentially raising increasing risks in terms of credit. But there's some other interesting parts of that as well. We noted the anti-cyclical nature of some of these institutions, which maybe could be a stabilizing factor in relation to financial stability. Probably most critical is to go back to my earlier remark, which was around the nature of cross-border transactions and the contagion risks that they bring. This, of course, has been a feature of historically of crises where international contagion is transmitted via international financial institutional groups and can be difficult to control and monitor. So we would suggest a couple of things, and I'd certainly be interested in other people's views on this, because obviously it's quite a debatable point. One is the fact that there needs to be assessment of these type of risks as a fundamental part of macro-prudential regulation, including through some of the interregional regulation I mentioned earlier. But we'd also suggest that there may be a role for crisis planning and scenario analysis to prepare in advance approaches to cooperation and controlling cross-border contagion risks in the event of market stress. The reason for that is, of course, the market stress can mean that these events arise very rapidly and cause acute problems, and therefore, without preparation, it's difficult to control. Some of the examples of things that might be considered in that type of preparation is examining who are lender of last resorts for banking groups and what would be the respective roles of different authorities in which they operate, and also ground rules for managing cross-border liquidity and capital transfers during market stress. There's arguments, I think, both for liberal approaches to that, but also to ring fencing, particularly around holding companies and subsidiaries within individual jurisdictions. Let me hand the floor back to Bowser. Moza, would you like to take it from there?
Yes, thank you very much for this excellent presentation. It's actually important, and I can see a lot of engagement coming from our participants. Just to start with a quick question from a participant who actually wants to know what exactly Pan-African Bank stands for. So there is a question from Ivy, who wants to know what Pan-African banks are.
What some of those examples do we mean?
Yeah, what exactly is a Pan-African bank?
Oh, so we I forget. I think there was well, there was a quantitative analysis of it, but it's basically, you know, an institution that is headquartered in one jurisdiction and then has operations in other countries. And I think there's two examples of it. There are some truly regional banks that cover most, you know, large or predominant countries within Africa, particularly in sub-Saharan Africa. But there's probably more examples that are sub-regional. So we have banks that tend to be clustered around their countries of origin. So in East Africa or West Africa, and also in Southern Africa.
Excellent, excellent. So there is also another quick follow-up from the same participant who wants to actually know the sources of funding for this particular Pan-African banks.
I think one of the interesting questions that came out of the research actually is around this, because as Sherilyn highlighted, the level of deposits that these banks hold is relatively small. Right, so we mentioned about 10%. And if you look at that relative to the scale of our operations, it's not particularly significant. And I think it suggests two things. One is that there is a case to be made about why they're not mobilizing more deposits given their concentration in households. And this, of course, is quite an important aspect of broader financial development and raising finance for development in the region. It's long been one of the policy goals, including some of the major regional political organisations in relation to financing development. The other issue is around the stability of their funding base. Because it suggests that the majority of their funding is coming from wholesale funding. Some of that is from committed institutions. We see these banks being used as conduits for donor financing, which is typically ring-fenced for SME or, you know, bottom of the pyramid type financing. But it also suggests possibly an excessive reliance on wholesaling financing from markets. And of course, I highlighted some of the financial instability risks, but this is a key cause of contagion risk and of institutional failures during financial crisis. So it's something where perhaps there's a question mark. I suspect, lastly, I'll just comment on that, there's probably a range of funding structures for different institutions as well. So we should look at individual institutions in terms of their risk.
Excellent. I can see a lot of interest in this particular topic. And given the kind of questions that we are receiving and the kind of engagement participants are actually showing. There is also a quick question from Ivy Aqua, who wants to know, and for instance, given the drivers of Pan-African banks, like Sherilyn made mention earlier, regarding the host factors and then the home factors, in terms of the regulations, which particular factor or host country, is it the host country or the home country that actually uses their regulations to, you know, to regulate the activities of the Pan-African banks? So specifically, Pan-African banks regulated by the home or host countries?
I mentioned earlier about the need for interregional you know, cooperation and discussion. This is really one of those institutions, because a typical structure would be that where there's the group holding company, the regulator there has oversight for its international operations as well. Whereas for branches or subsidiaries, those host supervisors typically only have oversight for those individual organisations, but clearly that kind of clear definition is something that needs to be clarified for all jurisdictions in the region. Sherilyn, would you like to add anything to that?
Yeah, so yeah, I agree with Judith. So actually, as we've seen, like also this is a emerging problem when we did the interbank market paper and also this Pan-African banking paper, because the regulatory burden for supervision of cross-border banks or regional banks is a very challenging part for regulators. But we've seen, like, for example, there are also emerging efforts already on the way, like South Africa has been doing consolidated supervision already. So they may serve as like a model or like a template that can be tailored by other host countries that have major PEBs within their jurisdiction. There's also like cross-border supervision initiatives by Nigeria. So this can, like the West African, this may be more tailored to the West African countries have hosting PEBs. Uganda also has initiative to create MOUs for foreign banks entering in Uganda, so they can have like internal arrangement with other supervisors of these PABs hosted or headquartered outside Uganda. So these are little efforts, but it's an emerging challenge to have this institutionalized, if we can say, so we can better monitor the activities of the larger PABs themselves.
Excellent, excellent. Judith, in terms of the national regulations, during the presentation, you made mention of maintaining some level of high regulatory or supervisory standards for PABs as SSI, and someone is actually asking the full meaning of SII.
Oh, so sorry, that's a systemically important institution. They're essentially dominant institutions within financial systems, and that term comes from the Basel III framework, which was the reforms after the global financial crisis in 2007 that was enacted internationally. And there are additional supervisory requirements and capital requirements for institutions who are identified as systemically important.
Excellent. Let me quickly go to our key discussant, who has at most 2 minutes to just give his opinion on the presentation before we come back to the Q&A session. But let me also mention that participants, if you have any question, you can go live by raising your hands, and we will give you the floor to be actually to have a direct conversation with the panelists. Thank you so much. So on this note, I will hand over to Segmian, who is the Director of Investor and Partner Relations at Ora Bank based in Togo, to give a quick, remark on the presentation before we get back to the Q&A session. Sam, over to you. Hi, Sage, can you hear me?
Yes, can you hear me as well?
Excellent, excellent.
Okay, great. Thank you very much for the invitation. I can make some comments on the reporting, which is actually very comprehensive. Thank you, actually, for the study and the authors as well. Our group bank is, established in 12 countries. Though actually, we are a Pan-African bank. We are in 4 different, currency zones, serving more than 500,000 clients. And the good thing is about financial access is definitely we are very involved in the financing of the economy. We used to finance only, the government supporting, in the bond and government bonds. But the thing is, actually, we are now very diversified. We finance only SMEs projects, big corporation projects. We assist some institutional investors in PPP projects, and we are very supportive as well of anything linked to gender investment and even green project initiatives. So definitely, actually, we strengthen the financial access in Africa. Same thing for competition and efficiency. Definitely, the good thing about Pan-African Bank is our market proximity. We are very much in the center of the social and the economic environment of our clients, as our headquarters are based in Africa and not overseas. So that clearly speeds up our investment decision. And I would say that actually we are becoming more and more effective and efficient. You can see in countries like Togo, Benin, Mauritania, or Gabon, the leading banks are definitely Pan-African banks. And just because now we have the knowledge, we have the human resources to be as profitable as foreign banks. I can say maybe that one advantage that those foreign banks has among us is the access to the international FX markets. Actually, it's very difficult for us, to get access to the euro or the USD syndicated market, for example, when we want to finance, big infrastructure projects. On the micro and the micro prudential risk side, I would say that actually, I can say that maybe the small banks and the newcomers actually that gets into the industry are pushing actually to lower the price. But I can see that the regulators is very aware of the situation, and as the regulation has stiffened over the past years, I can say that the system is definitely well overseen and prevents any kind of market turbulences. I would add as well about the regulation that I think it's quite a good thing for the business. You know, the market is becoming more and more complex and sophisticated, which brings new actors and which actually gets the bank to create new products as to satisfy the customers, and is definitely a good thing for the markets. And for the moment, the main difficulties for us is try actually to finance projects from one country to another. For example, we are based in Togo. Most projects that the bank has financed are mostly, you know, customers, big corporation in Togo. It's very difficult, you know, to finance projects in Ivory Coast or in Senegal because of the regulation, because of the type of guarantees, and because of the legislation. And I think our wish for the next years is to find ways so that banks actually can cooperate in different countries and be able to finance projects irrespective of the jurisdiction and the country. So these are some elements, you know, I can say about the report. So happy to complement it if needed. Thank you.
Excellent. Thank you so much, Serge, for this insightful feedback. It's actually well appreciated. Let me also remind that we have over 100 participants, and feel free to raise your hand. You'll be given a live opportunity to interact with the panelists. If you have any questions, comments, the floor will be given to you once your hand is raised. Just coming back to Judith and Sharon, based on the questions and the findings that actually came out from the synthesized report, it is clear banks are exposed to some default risks from SMEs. How do you actually see Pan-African banks shaping financial sector development in sub-Saharan Africa, especially in the light of COVID, given that countries are particularly exposed to some form of exogenous risk? So just wondering, going forward, how do you actually see financial sector development in sub-Saharan Africa being shaped by these Pan-African banks on the back of what we currently have at hand, referring to COVID pandemic?
Yeah, I would say they've been very instrumental actually in progressing financial development for the region. And the reason I say that is because their business models have, as we mentioned, pushed down into the SME and household sector, and therefore, you know, they've been absolutely a conduit for the expansion of financial access, which is one of the, you know, big success stories for financial development in the region. And Alan mentioned, you know, in relation to his activities, but I would say more generally for Pan-African banks, they've also been instrumental in that regard in supporting economic development. And as we know, the SME sector and the informal sector are very key to economies across the region, and financing is a key constraint. So where we see these developments, I think they're very positive for accelerating economic growth and also for the inclusivity of that growth. So yeah, I think, you know, we've got a big tick in the box in terms of their contribution. I think it's going to be interesting to see what's happened during the COVID period in relation to the stability of their credit portfolios. Clearly, we've unfortunately seen a live stress event and stress where informal livelihoods in particular and SMEs have been impacted by the economic consequences of the pandemic. Obviously, we haven't seen the data around that fully fleshed out yet. So it remains a question mark, but we certainly also haven't seen particularly you know, stress on institutions or any institutional failures. That's partly can be you know, the result of regulatory strengthening in the last decade across the region, and including you know, the building of capital bases and the strengthening of regulation more broadly. So, you know, it's a big achievement of regulators in the region that we have seen relative financial stability during this period. So I would comment on that. I would say also to Alan's comments, you know, they also highlight a little bit, though, some of the deficiencies in financial development. So he mentioned the difficulty of accessing finance. Of course, what would be ideal would be deeper capital markets, local capital markets in the region where financial services companies are key participants. That would also enable them to have local currency financing that matches their liabilities. You know, and some issues about things like project financing, which is still relatively nascent in some jurisdictions. let me finish there.
I would also just briefly add something on what Judith has said. I agree that, PABs will have a very critical role in the economic recovery through their SME lending. But I think, I think the challenge for the regulators is to be more alert on the financial soundness indicators of PABs. For example, like the AFDB latest report their latest outlook report indicate that in some countries non-performing loan ratios have increased by as much as 7 percentage points in 2020. So depending on how credible like the financial portfolio of PABs will matter, whether they will be channels of opportunity or risk in the economic recovery from the pandemic.
Great. We have a hand raised by Pasonkro Alain Sek. Over to you. Let me be quick to add that for a question, you have a minute, and to make a comment on the presentation, we will be able to give you 2 minutes. But if it's a question, we want it to be brief so that we can engage with the other participants. So over to you, Alain.
Okay, thank you very much. Can you hear me very well?
Excellent, loud and clear.
Okay, my question is as follows. First, we want to thank all the presenters for this very important presentation, and also for this subject of great importance for African development. And I have 2 questions. The first one is as follows. We all know that the impact of the 2008 financial crisis in Africa was relatively reduced because of the relatively low degree of openness of our African banks. Okay, so we have noticed a relatively reduced impact of the 2008 financial crisis. So my question is as follows. What do you think the role of the PABs in Africa might be if we have to face another financial crisis that comes from abroad? I'm talking about role in terms of reducing the impact of the overseas financial crisis on African economies, because the evidence is that, as demonstrated, we have noticed an increase in Pan-African banks, and the presenters tell us we moved from 94 in 2003 to 173 in 2011. So if you have to face another financial crisis coming from abroad, Western countries, what will be the role of the PABs in terms of reducing the impact of those financial crises coming from abroad on African countries? This is my first question. And my second one is as follows. Do we have some evidence of the impact of the PABs on the rate of bankarization or any other indicators related to financial inclusion? Thank you very much.
Excellent. Thank you very much, Alain, for this excellent question. Just to quickly paraphrase for Sherilyn and Judith, his question actually has to do with the level of contagion with regards to how Africa's financial sector is exposed to the well-developed economies, financial markets. So in the case of Pan-African Bank, it's actually improving the financial integration, opening up financial sector borders. The much more concern has to do with, are we able or better prepared to be able to withstand some form of high contagion if we are going to have to be hit by some form of financial crisis?
Okay, let me, maybe I could take that question then, Sharon, and you could answer the financial access one. I think when we think about, the 2007-2008, quote, global financial crisis, of course, the region was relatively unaffected. And unfortunately, though, that really reflected, if you like, financial underdevelopment, in the sense that there was a lack of integration of much of the African financial system with the international financial system. I think that's changed quite significantly in the last decade, where of course we've seen a lot of growth in the financial sector per se, but we've also seen increasing linkages. We highlighted in this presentation the interregional linkages, but there are also growth in international linkages, which of course are the channels for contagion from international crises. I think when we think about those risks, I think it's also useful to think about what's happened in other regions, particularly in Asia and Latin America, where their financial systems entered a similar stage of development, and particularly as countries became middle-income countries and became more integrated, not only through the financial system, but also through trade and other economic links. Probably the key thing was around international financing, and particularly dollar funding. Alan mentioned, the need to access US dollar funding or through, Euro bond markets. Of course, we've seen this quite significantly in the sovereign bond markets, but we've also seen growth in the corporate bond markets, including financial institutions. And that type of funding is what we always refer to as the original sin in terms of financial crisis, because it is the classic mistake where we have balance sheet mismatches between local currency liabilities and local currency assets and US dollar liabilities in terms of that funding model. So those are probably some of the key things that you'd want to look in terms of financial contagion as opposed to economic contagion. We mentioned too earlier the business model. I mentioned the need to develop alternative sources of funding. Absolutely, local currency deposits would be the key one. They're stable, they're cheap, they help mobilize finance for investment, but also local currency capital markets as well. So I think those would be the key things to think about, both in terms of the risks, but also how to protect African financial systems against some of the mistakes that other regions have suffered from.
Excellent. I think the second question has to do with one of your key findings on how Pan-African banks actually influence financial inclusion and financial access. I think what Alan wanted to know was whether there is some empirical evidence supporting the precise effect of Pan-African banks in explaining countries' differences in financial inclusion, whether there are some existing evidence regarding how Pan-African banks actually influence financial inclusion in Africa.
Maybe I should pitch in this question. So yeah, there's empirical evidence that Pan-African banks compared to other foreign banks have been financing more to firms, especially small and large firms, and also young enterprises. This means like enterprises below 10 years old. But the impact on household is a bit less clear, because, well, we find that there's evidence that PABs don't target opaque customers. So effectively, they may be competing with the same creditworthy household level customers with other foreign banks. But I think we should highlight that their active role in the SME lending might be indirectly improving household wealth. As you can see, there's also a dire need for SME lending in Africa, and many of the low-income and informal households are being employed in these SMEs. So indirectly, the PABs may be helping in like easing the financial constraints by having more predictable income from SMEs that are, being funded by PABs.
Excellent, excellent. There is also another critical question from Gilbert. And his question is on how differences in regulatory regimes, including lapses and some arbitrage opportunities in Africa, contributes to financial stability of the Pan-African banks, and what exactly can be done to actually surmount this particular challenge. So critically, how regulatory regimes, arbitrage opportunities, and lapses within the African financial sector actually contribute to some financial stability, if I may put it, or sustainability of Pan-African banks?
I'm going to say that I'm not sure of the answer for that for Africa. I don't know if any of the regulators who are on the call would like to comment. One thing I would say, though, is that where we don't see regulatory harmonization in other regions, we see quite significant regulatory arbitrage being conducted by banks in their operations. So it's not always a negative thing, but it often is, because they will look for opportunities to reduce capital, reduce taxation, and manage liquidity in a way that maybe isn't functional for the financial system, if those arbitrage opportunities are allowed to exist.
Yeah, there is an interesting question. I don't know whether it has to do with political economy, but there is a question from Labi who wants to know why cross-border banking businesses in Africa is not relatively well developed, and is asking whether is it because of political restrictions.
I'm not sure that I would agree with that statement. I think it is quite well developed. I mean, we've seen very significant growth. There are some countries where financial access and PABs are not particularly active, but they're, you know, I think it's driven largely by commercial drivers rather than political ones, personally.
Excellent. Another quick one, also from Bruno. And the question goes, have you measured with what kind of metrics the impact of financial PAPs on access to finance? And I think this critical has to do with the empirical aspect of it. So the question is on the empirical effect of Pan-African banks on financial inclusion. And I think Sherilyn earlier just mentioned that in terms of SMEs, households, and some of the differential effects. We have Abdel Ghafaru, who also has his hand up. And let me also remind that you have 1 minute to ask the question, and you have 2 minutes if you're adding a comment. Over to you, Abdel Ghafaru.
Hello, good afternoon.
Yes, good afternoon.
Yeah, my name is Abdul Ghaffar. I'm a central banker from the Central Bank of Nigeria. My question is that for us here, we understand the SSI to be domestically systemic important banks. And one of the things I think I've not really seen here is issue of anti-money laundering, and also the issue of a cross-border synergy. There are times that as an examiner, it becomes very difficult for you to get information from your host countries. So what are the things some of these Pan-African banks are doing to ensure that we have a situation where we can have seamless information in terms of a cross-border supervision? I think that's my question for now. Thank you.
Do you like to take that or?
Okay. Yeah. So thanks for that question, and it's always a good thing to have conversation with central bankers from the region. So as I've mentioned earlier, yeah, this is a very difficult and always cited problem in the literature on cross-border supervision. So I think, well, what for example, the other countries' approach is to have an MOU even before like giving a license to a PAB to operate in their country. Then there's an MOU between host and home countries so that they can exchange information to a certain extent. So that can be done for new PAB trying to enter Nigeria, for instance. But for those who are already there, we may follow some of the steps taken by Uganda for like creating MOUs with different host countries. So to some extent, also cooperating on what information can be exchanged. This is difficult, but I think this is a way to go. This is like, of course, the ideal situation is for harmonization of rules and regulations and adopting international standards like basic harmonization of accounting rules. But for what we have now, I think having MOUs is the way to go to alleviate the information gaps.
Excellent, excellent. So we have Gina Rao who also wants to interact live with the panelists. Gina Rao, I would encourage you to keep it brief as we have less than 10 minutes to end this webinar. Over to you, Rao. Hi, Rao. You are on mute, Rao. Okay, so I can actually see Rao's question. It has to do with swaps. And the question is whether Pan-African banks are able to offer swaps and derivatives in the markets that they actually operate in terms,
Yes.
yeah. Yes, Raul.
Thank you so much for this. It is a very interesting paper, and I have a couple of quick questions. One is, many of these Pan-African banks will have, given the fact that they have the ability to trade the govies in the particular country that they operate in, I was wondering if they have the capability to offer derivatives products, because now they have the technology, they're holding the govies, then they can short them or they can go long based on what the clients need. And will they be able to deepen the financial sector by offering products like that using their capability and the technology that they already have in their home base? That is one question. Second, the reason why this becomes important is because one of the comments which Judith mentioned, which is at the short end, if you want to raise money using depots are at near zero rates, whereas the govies tend to be at very high rates. Somehow I'm hoping that we will be able to use these mechanisms to offer financing and offer products to SME customers at levels which are somewhat palatable when you factor in the cost of funding plus the cost of risk. Thank you. I hope I'm being clear on the questions. Thank you.
Maybe I could take those questions. I just wanted to respond to the Central Bank of Nigeria about a little further on the illicit financial flows. One of the things that is probably quite or that has worked elsewhere is around the exchange of information on a very granular level in relation to beneficial ownership of financial transactions and financial assets. And I'm sure you're aware that I'm thinking here about the G20 and some of the initiatives for offshore financial centres, where those type of initiatives, either not necessarily in public databases, but exchanged between appropriate authorities, whether they're legal or regulatory authorities, and their ability to access information have been quite powerful. There, of course, they've been focused on tax, particularly on tax avoidance, but also on identification of illicit activities. There's also, by the way, in that regard, some anecdotal evidence of illicit flows now moving within the region, and particularly into real estate markets. So I think it's quite an important one to focus on. Let me just comment too on the issue about swaps and derivative markets. I think it's a tough one, because I think when you think about the fundamentals needed for swap and derivative markets to develop, and certainly liquid OTC markets, there's a need for liquid underlyings. And so if you look at the government markets, there's only really a few markets even today where certainly secondary markets are liquid. We do see more advanced markets with prime brokerage, but they're still typically assets which are hold to maturity assets from institutional and other sort of major investors who are interested in those type of holdings. We don't really see liquidity in secondary markets, and without that, it's very difficult to market those, or benchmark in any way those type of derivative instruments, because it's difficult to see continual data for things like assessing volatility. So I would say we see very limited derivative markets, but probably will continue to do so, certainly in the short term.
Excellent. And I'm very glad that you've actually touched on exchange of information and cross-border supervision. And this actually ties directly with a huge question. Huge, who's a lead within our Making Finance work for Africa Secretariat. His question is actually on exchange of information and cross-border supervisory cooperation among relevant authorities like central banks and other agencies. And I'm glad that you actually touched on that. I think we also have Richard Kitchen, who also has his hand up for a quick question. So Richard, you have the floor. Let me also remind once again that you have a minute to ask the question. Richard, over to you.
Thank you, Mazen. And just briefly, do you have any feel from your work on the extent to which Pan-African banks have facilitated cross-border financial flows? For example, from parent to subsidiary, or subsidiary to parent, or even subsidiary to subsidiary. For example, you could think of investment financing, of remittances, and negatively, something you touched on a moment ago, on illicit financial flows and money laundering. One thinks of illicit financial flows going from Africa to outside Africa, but they may well also go within Africa.
Let me just take your question, as we've run out of time on illicit financing. I think this is really kind of an important issue, but the trouble with assessing it quantitatively is, of course, that illicit financial flows are hidden. There's been some interesting work that looks at things like gaps in balance of payments that try to assess it, particularly by my colleague Antonio Ducumana, who you may know at MIT. But I think it's difficult to assess that almost by its nature. I referenced there the anecdotal evidence, so I think there's some pieces that you see there, and I think there's some evidence that flows that went through international financial centers have been deflected within the region.
Excellent. I've seen a couple of questions, and I've seen a couple of questions from William Clark, and I will just pick one key one to end the session before I take your closing remarks. And Clark asked several important questions. Unfortunately, we don't really have much time, but I'll just quickly highlight one. And William wants to know whether for this particular Pan-African banks, in terms of determining their ability to lend, what criteria do they actually use? Whether there is an underlying collateral, an asset, or whether they have some form of criteria, special form of criteria that they use in lending to SMEs or households.
I don't know exactly the criteria, but I would guess because it's in the SME and household sector, it's largely uncollateralized. And the issue with that is, of course, that it tends to make funding short term, because we see banks looking for rapid turnover in terms of cash flows. Sharon, thank you for your question.
Yeah, there's a very little evidence on detailing the individual criteria of PEBs for lending at the household level, but the common factors that are emerging is like the level of income and education. That's why, unfortunately, there's the emerging evidence is that PEBs tend to target middle-class educated population at the household level. Although they're very active at the SME level, but at the household, they tend to cater to middle class. Well, this is maybe possibly because it's very hard to secure credit information as well. And this may be also a challenge for PEBs, even though they know the working environment being African country as well, coming from African country as well. But at the household level, they might need some hard credit information. And this is very difficult to the largely informal population in sub-Saharan Africa.
Excellent. I've seen an impressive engagement with the panelists, several questions coming in left, right, center. Unfortunately, we don't really have much time. I will quickly give Sherilyn and Judith just a few seconds to give your closing remarks before I end the session and hand over to my senior colleague, Guy.
I think I'd just like to thank all the researchers who put it together. It was led by SOAS, Professor Murunde, who I'm sure many of you are familiar with, and it was a synthesis report. So many thanks to all of them for their wonderful work, and thank you to the panelists and all of the audience for the great questions.
Yeah, I also want to thank of course, Making Finance Work for Africa for facilitating this co-hosted event with ODI, and we're looking forward to engaging more with practitioners and also the wider population from Africa, to which our research is actually catered to. So thanks very much for hosting this and looking forward to future collaboration with you.
Excellent, excellent. Thank you so much. And just a quick remark. Based on the conversation that we've had so far and based on the available evidence, we really need to have much more discussion of this sort, particularly from the empirical aspect, how the Pan-African banks empirically drives financial sector development in Africa. Just to summarize the key findings, I've picked two key issues. One has to do with their ability to improve or increase financial inclusion. And the second one, which is unfortunately Pan-African banks actually increasing financial instability in Africa. So given the renewed interest of our country's central banks to actually improve financial inclusion on one hand, and on the other to also, reduce the level of financial instability. So once the evidence is actually showing that on one hand, Pan-African banks is actually increasing financial inclusion, and on the other hand, it is also increasing financial instability. These are two quick, opposing views or issues that central banks and other key players within the financial sector will have to actually deal with. So increasing financial inclusion, increasing financial instability are two key conundrums that central banks and other financial sector players will have to deal with. Thank you so much, Sherilyn, Judith, and all the participants. And for those that we are not able to engage, we really promise to actually reach out to you if need be. But don't forget to actually read the full extended report, which is freely available online and also shared in the chat box. Over to you, Guy. Thank you so much once again.
Thank you, Mozu, and thank you to all speakers. Thank you to all participants. If you have any other questions, please feel free to contact Making Finance Work for Africa or ODI. Let me please remind you that once the webinar ends, you will see a survey on your browser. Please, we'll be grateful if you could complete the survey and provide some feedback. You also receive a follow-up email within 72 hours with a link to view a recording of today's webinar. Finally, on behalf of Making Finance Work for Africa, on behalf also of ODI, thank you for attending this event and stay safe. Thank you all. Bye-bye.
Thank you. Bye.
Thank you.